Hey guys, Mr. Donovan, Realty, part of the Johnson Group here in beautiful Savannah, Georgia. And today, I got Christina Boyette from New American Funding here.
Hey.
And she's going to be answering a bunch of common questions that a lot of people have during the home buying process. But first, if you get any value from this video, do me a favor. Like, share, subscribe. Share this video to friends and family looking to buy a home. If they have some questions about the home buying process and loans, well, this is the place to be. So let's just get right into it. Are you good to go?
I'm ready. Give me some questions.
Let's do this. You know what I'm saying? Let's just get into this. All right. Here we go. Okay. So a lot of times what I run into when I talk to clients is a lot of times there's a lot of clients out there that have student loans. So can I ask you a question, Christina?
Yes.
Can you get a home loan if you have student loans?
You can. We will look at the debt to income. That's the biggest issue with the student loans is the debt to income. So we'll really look at that.
Well, what is that? For them so they can know.
So debt to income is the amount of money you're making each month versus the debts that's on your credit report. So, we're seeing a lot of student loans without payments on the credit report. But that doesn't mean they're deferred. If they're deferred for at least 12 months, then we don't have to add a payment. But if it's not deferred and it's zero, we have to add a payment.
Are you talking about 12 months from the point when they apply for the loan?
Yes, it'll show how many months that is deferred.
Okay.
And it should at least be 12 months.
Okay, and then is this like a lot of it coming from the COVID stuff, or is it like COVID deferrals or just regular deferrals?
No, these are just regular deferrals. This is not COVID deferrals.
Ah, okay. Okay. All right. Is there a difference? Well, that should be over now, right?
Yeah, it's pretty much over.
I don't have student loans, so I don't know personally. Okay, so debt to income ratio is the biggest factor in that?
Yes. So we have to add a half a percent for a payment on some of our loans, and then some's 1%. So that can be very high. But some programs will also allow for an income-based payment. So you would go online and you fill out this form, and it would give you an income-based payment. And so I would recommend doing that because the payment's going to be much lower.
And then your debt to income ratio would be lower. So
right.
Helping you qualify for the loan.
That's
okay.
Right.
That makes a lot of sense. Okay. All right. Can a buyer buy a home? Okay. All right. So this next one question, and I think this is a good question because we're getting a lot of people coming from, out of the country. Really, the Hyundai EV plant out in Bloomingdale. Well, down 16. If you live in the area, this thing is massive. If you don't live in there, it's like huge. Have you seen it?
I have. It's huge.
It is like.
It's like another city.
It actually is. It's the size of a city, so it's massive. So we're getting a lot of people from Korea coming on over to help us get the plant off the ground, and a lot of them are going to work there. So the question here is, can you buy a home without a Social Security number?
You can. So instead of having a Social Security number, we would want your tax ID number.
Okay.
Now, the regular loans, the regular Fannie, FHA, Ready, they won't allow that. So these would be our broker loans. So New American Funding, we have what's called broker loans, and they will allow for a tax ID number. Now, it does come with a little bit of a higher rate. It's because it's a higher risk. There's no social. But that's really the only bad thing about it is, which is not really that bad, is it comes with a little bit of a higher rate.
Okay. And so no government loans?
No.
Okay. Okay, that makes a lot of sense. All right. So myself, being self-employed, just like a lot of others, like truck drivers, real estate agents, some lenders, they're self-employed. So can you get a loan if you're self-employed, and what does it require for them to get it?
Yeah, I feel so bad for self-employed. They really get it in the mortgage area because, the regular FHA and conventional, they're going to want tax returns.
Right.
And we all know with self-employed, you get all the write-offs. That's the whole name of the game.
That's the advantage.
Right?
Right.
Write everything off. And in everyday life, that's not a big deal. But with mortgage, we have to go by what you tell the federal government that you make. And that's after the write-off.
And if it's zero every year, that becomes a problem, right?
Very big problem.
I make nothing every single year.
Those again are part of our broker loans. If we can't get you approved by tax returns, we will look at the broker loans, and they will allow for bank statements.
Okay.
It's called a bank statement loan, and we have several broker loans that will do it, and some of them are for 12 months bank statements, and some require 24 bank statements.
Okay.
And so we just collect those bank statements. If you go the 24 route, it's going to come with a better rate than the 12-month.
Why is that? Just because you've been self-employed for 2 years as opposed to 1?
Well, we're collecting information over 1 year versus 2 years, so it's a little bit of a higher risk.
Right, because you're trying to hedge the risk. If they've only been self-employed for 1 year and obviously make no money, you got to hedge your bet. I understand that. That makes sense. Okay, so if you did 24, if you've been in business for longer than 24 months, you should be good to go. This should be able to help you out.
And the best part is I don't have to figure out the income.
Oh, yeah?
I love that because you have to really look through all the deposits, through those bank statements.
24 months of bank statements.
So that could be daunting, and you could make a mistake. So fortunately, right when we get an application and we gather the documents, I send them to the underwriter immediately, and they figure it all out. And you get the same underwriter underwriting the loan, so there's no mistakes. So
and the underwriter is the approval, right?
Right, he's the one that says, or she says yes or no if you get the loan.
Right, it's not Christina.
Not me.
Underwriter. I think I cover these in a lot of our videos. I just want to make sure everybody understands, the difference between the, originator and the underwriters, because they both play crucial parts, but the ultimate one that approves you is the underwriter. So, okay, so I like
questions.
Thank you. Well, this next one is weird because I think a lot of times there's confusion with points, and I think we had talked about in a previous video about how the fees move up and down all the time, right? So, can you explain what points are, and I'll try to help as much as I can to explain. So, can you explain what points are?
So, the points are tied with the rate, and the rates change every day. In fact, they can change several times in one day. So we look at the rate sheet and of the day when we're quoting rates and points, and the points and rates are different. So you can pick a rate with no points, or you can pick a rate with 1 or 2 points. So that's your choice. You can choose either way. If it's no points, of course, there's no points, but that's going to be a higher rate than if you buy a point. You're really buying down the rate. So at 1 point, you're going to get a lower rate. At 2 points, you're going to get an even lower rate.
Right.
But the fee part goes with the loan amount. So if you buy 1 point, then it's 1% of the loan amount. So if the loan is $4,000.
$400,000. Each point costs.
You're paying $4,000 for that 1 point.
All right, and the one thing, and we had talked about this earlier, and I knew this, but I know it's confusing because actually I learned it from Christina, so that's how I know. But to try to make it easy so you understand, so 1 point cost you 1% of the loan. So like you said, $400,000 loan, so 1 point cost you $4,000. But the points are not always equal from one moment to the next, right? Because the points move up and down. So 1 point could be worth 0.25%. And then the next day it could be worth 0.5%. And then the other day it could be worth 0.1%. So this is where it's very important you talk to the lender, Christina, and be like, okay, how much are the points worth on these days? Because maybe she's going to advise you, hey, I heard that maybe something's going to happen a little bit later, so maybe hold off a second, or maybe you want to lock these points in now. So she's going to try and help you out to save you as much money as possible, because every point, regardless of percentage-wise what they're worth to the interest rate, are still going to cost $4,000 regardless.
Right. And if you're comparing from one lender to the next, you're going to want to ask, well, how many points are coming with that rate?
Right.
If you're asking that, they could be quoting you a rate with 2 points, and I'm quoting you with with 1 point. So that might look like a better rate, but you're going to be charged a lot for that.
And this is where the APR comes in, right?
That's right.
Right.
We had a discussion about
a good one about APR. If
Yeah.
you check out this video up here, I'm going to put a card. My editor, Nick's going to put a card up here referring back to that video, but we really go into points versus, or excuse me, interest rates versus APR. So go back to that video, watch it. It's awesome. Okay, great. So we got, a lot of young couples trying to get into the market, getting jobs and stuff and, getting married young and they want to get their first home. But a lot of times they don't have money. But so could they call their mom or dad and be like, hey, look, I need money to buy a home. And could they use that as a down payment?
No, unfortunately, no. The
no.
down payment has to come from the borrower, the client.
Okay.
So the gift, it can be for the closing cost. So they can help you out with that.
Okay. Well, hey, that's half the battle.
Yeah.
Right.
But the down payment has to come from the client. And it can't be borrowed. Like you can't borrow money from your credit card to go for the down payment or go out and get a loan and use that for the down payment. You can't use a loan. You can use your assets though.
Okay. So what do you mean by that?
So if you already own a home, you can take out an equity loan off of that and use that for the down payment.
Okay.
Or, you can use stocks or your 401k if a 401k will allow you to take that money out. Those kind of things are called assets, and you can take money from that.
So you're saying if I wanted to go buy another home as an investment property, right?
Right.
I can take a HELOC off my house, use that as the down payment for my rental
Absolutely.
property?
Yeah.
There you go.
Yeah.
That was easy. Thank you. No, I appreciate it. Because we were talking about that with a client we had. He was looking to take a HELOC out to buy land, and I wasn't sure that it was possible. Christina had talked to him, and so you can be done. That's great. Okay. Now, a lot of times, this is, I think this, I don't know if this is standard, right? But at least what you guys charge. What is the minimum down payment required for, a home loan?
Yeah, so all the products have their own amounts, different amounts. So FHA is 3.5%. Then you have your conventional loans. We have two. One you can put as little as 3%, and then there's another one as little as 5%.
Okay.
Then you have VA with no down payment.
Right.
Then you've got USDA, which is no down payment. And then we have our down payment assistant programs.
Okay.
You can choose those. We've got quite a few pathway. I think we have 5 or 6 pathway loans, and we've got a couple of Chenoa loans, and those would help you. You have your Georgia Dream that can help with down payment.
Yeah, there's a lot of great programs out there. They all come with their different various things. USDA, you have to be in a USDA territory, which is considered rural. Like in our area, if you go north of 95, right? Basically, essentially. So north of 95 that runs through our area, a lot of that is USDA. Now, Hinesville, they kind of locked out Hinesville from the USDA because there's like, no, you can't. If you're in Hinesville, no longer USDA territory, but, like Rice Hope, Bloomingdale, there's Rankin, Guyton, a lot of great places to live are qualified for USDA. Obviously, VA comes with a VA funding fee, but if you're disabled, you don't have to pay it. Then all the Chenoas and all that have their own little thing, like the Georgia Dream. Don't you have to go to a class?
Yes.
Yeah. So there's other stipulations. So when you are getting ready to do this and you may not have the money for the down payment, give Christina a call. She can give you a ton of options out there. They're there. Okay. They just have their own different requirements, maybe a different interest rate. Just really depends on the program you use. So Christina, I want to thank you so much for coming. I really appreciate it. Ask a lender every month. Hey, we're going to be doing this every month. So if you want to see Christina answer any questions, if you have questions, hey, put it down below in the comments. She can answer any question you have if you're looking to move in this area. So don't be shy. Put it in the comments down below. And I really appreciate you guys watching. If you guys are watching this point, by the way, thank you so much. It means the world to me. Please share this video with your friends and family if you got value out of it. And I'll talk to you guys soon.
Bye.
Bye.